You wake up one morning, grab your phone, open your portfolio app, and your stomach drops. Red. Everything is red. The market is down 20%, 30%, maybe even 40%. Your friends are texting you in a panic. The news is screaming recession. Social media is flooded with people saying, sell everything, it's over, this time is different. And somewhere deep in your gut, you feel that same fear creeping in. Now here's the question I want you to sit with for the next few minutes. What if that exact moment, the moment that terrifies 95% of investors, is actually the single greatest opportunity of your financial life? Because here's what Max figured out years ago, and what the wealthiest people in the world have understood for decades. Market crashes don't destroy wealth. They transfer it, from the people who panic to the people who have a plan. And today, I'm going to give you that plan. A specific, actionable compounding strategy that is designed to work especially well when markets are falling apart. If you stick with me for this entire video, you will walk away with a framework that most retail investors never figure out, even after decades of investing. Why most investors get destroyed during crashes. Before I show you the strategy, you need to understand why most people lose money during downturns. Because it's not for the reason you think. It's not because the market went down. It's because of what they do when the market goes down. The average retail investor behaves in the most predictable, most destructive way possible. When prices are high, they feel confident. They buy. When prices are going up, they buy more. They tell their coworkers about their gains. They watch their portfolio every day. They feel like a genius. And then the moment the market corrects, which it always does without exception, they panic. They sell. They lock in their losses. They sit on cash, terrified to get back in. And then they wait too long, miss the recovery, and buy back in again near the top. This cycle is called buying high and selling low. And it is the single most common way ordinary people destroy their wealth over time. Studies have consistently shown that the average investor dramatically underperforms the market index they're invested in, not because they picked bad stocks, but because of their behavior during volatility. The market doesn't care about your emotions. It doesn't care that you're scared. It doesn't reward fear. But here's the flip side. It also doesn't punish patience. In fact, it rewards it massively. And that's exactly what this strategy is built around. The compounding engine nobody talks about. Let me introduce you to the core concept of this entire strategy: volatility harvesting through structured compounding. Now that sounds complicated, but I promise you it's not. Let me break it down. Most people think of compounding in a very passive way. You invest money, it grows, the gains generate more gains, and over time, you get rich. And yes, that's true. But that version of compounding is slow. It relies entirely on time. What volatility harvesting does is use market crashes as fuel for your compounding engine. It actively accelerates the process instead of just waiting for it to happen. Here's the principle. When prices drop, the same amount of money buys you more assets. More assets means more ownership. More ownership means more future gains when the market recovers. And the market has always recovered. Every single time in history, the Great Depression, Black Monday, the dot-com crash, the 2008 financial crisis, COVID in 2020, every single one of those events looked like the end of the world when they were happening. Every single one of them was eventually followed by new all-time highs. So if you know the market is going to recover, and based on all historical evidence, it will, then a crash isn't a disaster. It's a sale. It's the financial equivalent of your favorite store putting its best products at 40% off. The problem is that most people walk into the store, see the sale sign, and run in the opposite direction. This strategy is about training yourself and structuring your investments so that you do the opposite. Step 1. Build your war chest before the crash. The first pillar of this strategy is preparation, and it starts long before any crash happens. One of the biggest mistakes people make is that they invest every single dollar they have the moment they earn it. There's a version of investing advice that says you should always be fully invested, always have your money working for you, never hold cash. And in a perfectly rational world with no emotions and infinite patience, that might work. But we don't live in that world. We live in a world where markets crash, where emotions run high, and where opportunity is only valuable if you have capital to deploy. What Max recommends, and what I think every long-term investor should do, is maintain what I call a crash reserve. This is a separate pool of capital that you never touch during normal market conditions. It sits there, earning a modest yield in a high-yield savings account or short-term treasury bonds, waiting. It is not your emergency fund. Your emergency fund is separate. This is specifically, exclusively, dedicated to one purpose: deploying aggressively when the market drops. How much should your crash reserve be? A good starting point is between 10% and 20% of your total investable assets. So if you have $50,000 invested in the market, you want $5,000 to $10,000 sitting in your crash reserve, ready to deploy the moment opportunity strikes. This does two things. First, it gives you the ability to act when others can't. Second, and this is the psychological part that people underestimate, it completely changes how you feel about crashes. When your entire portfolio is invested and the market drops 30%, it's genuinely painful. You feel helpless. But when you have dry powder ready to deploy, a crash becomes exciting. You start wanting the dip to go deeper. Your mindset shifts from fear to opportunity. That mental shift alone is worth more than most people realize. Step 2. The tiered deployment system. Okay, so you've got your crash reserve ready. Now the market starts to fall. How do you deploy it? This is where most people mess up. They either deploy too early or they wait for the perfect bottom, which nobody can time, and never deploy at all. The solution is a tiered deployment system. Instead of trying to pick the bottom, you split your capital into 3 tiers and deploy each tier at a different level of market decline. Here's how it works in practice. Let's say you have $10,000 in your crash reserve. Tier 1, 10% to 15% market decline. You deploy the first $3,000. The market is down meaningfully, prices are already at a discount, and you're putting real capital to work. You don't know if the market will fall further, but you don't need to. You're buying quality assets at a 10 to 15% discount. That's already a win. Tier 2, 20% to 30% market decline. Now you deploy the next $4,000. This is officially bear market territory. The news is bad. Sentiment is terrible. People are calling for further declines. This is exactly where you want to be buying. You're acquiring the same assets you were looking at before the crash, now at a 20 to 30% discount. Tier 3, 30% plus market decline. This is full-on capitulation. The fear is at maximum. This is when you deploy your final $3,000. History shows that buying during peak panic, when everyone is convinced the world is ending, produces some of the highest long-term returns of any investment timing. By splitting your deployment this way, you take the pressure of market timing completely off the table. You're not trying to call the bottom. You're systematically buying as prices decline, which means you're building a position at progressively better prices. And if the market recovers after Tier 1, you still made excellent returns. If it keeps falling to Tier 2 and Tier 3, even better. You've bought more at deeper discounts. This is the system. Simple, systematic, unemotional. Step 3. What to buy? The compounding assets now. Where does all this capital actually go? Because this matters enormously. The wrong answer is whatever is down the most. People make this mistake constantly. They see a stock that's down 60% and think they're getting an incredible deal. Sometimes they are. Often, they're catching a falling knife. A company that's declining in value for fundamental reasons that won't reverse. The right answer is high-quality, cash flow generating assets with strong competitive moats. Let me explain what that means in plain language. You want to be buying assets that 1. Generate consistent cash flow. This means dividend-paying stocks, REITs, or broad index funds that represent businesses earning real money. Cash flow is the engine of compounding. When an asset generates cash, that cash can be reinvested to buy more assets, which generates more cash, which buys more assets. That's the compounding flywheel spinning. 2. Have durable competitive advantages. These are businesses that will still be relevant in 10 or 20 years. Think about companies with strong brand loyalty, network effects, switching costs, or regulatory moats. When the market crashes, these companies get thrown out with everything else, even though their underlying businesses are fundamentally unchanged. That's the opportunity. 3. Have manageable debt. Crashes are dangerous for highly leveraged companies. A business with a mountain of debt can survive in a bull market but get wiped out in a prolonged downturn. You want companies with strong balance sheets that can weather extended downturns and come out the other side stronger. If individual stock picking feels intimidating, or if you don't have the time to analyze individual companies, there's a simpler approach that works brilliantly: broad market index funds and sector ETFs. A total market index fund during a 30% crash is one of the most compelling investments that exists. You're buying a fractional ownership stake in hundreds of the world's best companies at a 30% discount with virtually zero risk of permanent capital loss over a 10-year horizon. Step 4. Dividend reinvestment, the secret multiplier. Here's where the compounding really kicks into overdrive. And this is the part that most people either don't know about or don't take seriously enough. When you own dividend-paying assets, those assets pay you cash regularly, quarterly, sometimes monthly. Most people take one of two approaches to this cash. They either spend it, or they let it sit in their brokerage account doing nothing. Both of those are wrong. The right approach is automatic dividend reinvestment, and during a market crash, it becomes an extraordinary wealth-building tool. Here's why. Imagine you own 100 shares of a high-quality ETF that's trading at $100 per share. The market crashes and the price drops to $70. Your portfolio is down 30% on paper. That hurts to look at. But here's what's also happening. The fund is still paying its dividend. And now, instead of your dividends buying you 1 share per $100, they're buying you roughly 1.43 shares per $100. Every dividend payment is automatically buying you more shares at the discounted price. And when the market recovers back to $100, then $120, then $150, those extra shares you accumulated at $70 are now generating dividends of their own, which buy more shares, which generate more dividends. This is the compounding loop in its purest form. The crash didn't destroy your wealth, it accelerated it. This is why wealthy investors don't just tolerate market downturns, they quietly celebrate them. Every month the market stays depressed is another month their dividend reinvestment is buying assets at a discount. Set up automatic dividend reinvestment in your brokerage account right now if you haven't already. It's usually a single checkbox in your account settings. One of the highest leverage financial decisions you can make. Step 5. Stay in the game. The psychological framework. Everything I've told you so far is technically straightforward. The hard part, the part that actually separates the people who build wealth from the people who don't, is the psychological side. Because all of this strategy falls apart if you panic and sell at the worst possible moment. So let me give you the mental framework that makes this strategy sustainable. First, reframe what a portfolio loss means. When your portfolio drops 30%, nothing has actually been lost unless you sell. Those are unrealized losses. They exist on a screen. The businesses you own haven't gone anywhere. Their products are still being sold. Their customers still exist. The loss is temporary. The only way it becomes permanent is if you choose to make it permanent by selling. Second, focus on units, not dollars. During a crash, stop looking at the dollar value of your portfolio. Start counting shares. If you owned 500 shares of your index fund before the crash, and you own 650 shares after using your crash reserve and dividend reinvestment, you are richer, even if the dollar number looks smaller today. Because when prices recover, those 650 shares will be worth far more than the 500 you started with. Third, read history obsessively. Every time you feel fear creeping in, go read about investors who held through past crashes. Read about people who held through 2008, who held through the dot-com crash, who held through COVID. The ones who held, and better yet, who bought more, built generational wealth. The ones who sold locked in their losses and missed the recovery. Let history be your anchor when emotions try to take the wheel. Fourth, write your investment thesis down. Before a crash happens, write a document. Literally just a text file, a note on your phone, whatever, that explains why you're invested in what you're invested in. When the market crashes and fear takes over, read that document. If your thesis hasn't changed, your behavior shouldn't change either. The compounding math that will change how you think. Let me show you some numbers because I want this to be real for you, not abstract. Investor A has $50,000 invested. A crash hits. They panic and sell, converting to cash at the bottom. They wait until the market has clearly recovered, which typically means prices have already risen 20 to 30% before they buy back in. They protect themselves from the worst of the crash, but miss the sharpest part of the recovery. Investor B has $40,000 invested and $10,000 in a crash reserve. When the crash hits, they stay invested with their $40,000. They deploy their crash reserve systematically according to the tiered system. They reinvest every dividend. They accumulate more units at lower prices. Over a 20-year period, the difference between these two investors in a historical backtest across multiple market cycles is not marginal. It's not 10% or 20%. The compounding effect of buying at discounted prices, reinvesting dividends, and staying in the game creates wealth gaps that are measured in hundreds of thousands of dollars, sometimes more. This is not a theoretical edge. This is a mathematically documented advantage that repeats itself, cycle after cycle, in every market in history. The people who execute this strategy consistently come out dramatically ahead of the people who react emotionally. The crash is not the enemy. I want to leave you with this. Market crashes feel catastrophic in the moment. They feel like failure. They feel like the world is falling apart. Every headline, every piece of social media content, every anxious conversation with friends reinforces the sense that something is terribly wrong. But from a compounding perspective, from the perspective of where you want to be in 10, 20, or 30 years, crashes are not the enemy. Complacency is the enemy. Panic is the enemy. Selling your best assets at the worst possible price is the enemy. A crash, when you have this strategy in place, is a gift. It is the market handing you the opportunity to buy world-class assets at a discount, reinvest your dividends at lower prices, and accelerate your compounding in a way that normal market conditions simply don't allow. The wealthiest investors in the world don't build wealth despite market crashes. Many of them build their most significant wealth because of market crashes. Because they prepared, they stayed calm, and they executed while everyone else panicked. That can be you. You now have the framework. You have the crash reserve concept. You have the tiered deployment system. You have the dividend reinvestment strategy. You have the psychological tools to stay the course. The only thing left is to actually implement it before the next crash arrives, because it will arrive, and when it does, you want to be ready. Start building your crash reserve this week. Set up automatic dividend reinvestment today. Write your investment thesis down tonight, and when the market turns red, and it will, you'll be the one quietly smiling while everyone else is running for the exits. That's how wealth is built, not by being the smartest person in the room, by being the most prepared.